If I took away your banking app today, could you explain exactly where your money went last month? Not roughly, not emotionally, precisely. Most financially stressed people aren't reckless. They're unstructured. They earn, they spend, they react, but they don't operate from a defined architecture. And without architecture, income leaks. In this video, I'm going to give you a completely different way to think about a 90-day financial reset, not as a budgeting challenge, not as a motivational sprint, but as a structural rebuild. By the end, you'll have a three-phase system that turns income into assets, automatically, calmly, and intelligently. The architecture model. Instead of thinking in weeks, we're going to think in three phases. Diagnosis, stabilization, acceleration. Most people try to accelerate before they stabilize. That's why they feel stuck. Phase 1, days 1 to 30 financial diagnosis. Imagine walking into a doctor's office and asking for treatment before running tests. That's how most people approach money. So the first 30 days are about measurement, not change. Step 1, build your personal income statement. Pull 90 days of transactions. Separate them into 4 categories. Non-negotiable living costs, financial obligations, debt, insurance, taxes, variable lifestyle spending, wealth building, investments, savings. Now calculate 2 numbers. Burn rate, total monthly spending. Wealth rate, percentage of income going toward assets. Here's the uncomfortable insight. Many middle to high earners have impressive salaries and near zero wealth rates. Income creates the illusion of progress. Only asset accumulation creates progress. If your wealth rate is below 15%, that's your real bottleneck, not your salary. Step 2, identify structural weaknesses. Look for patterns, not individual purchases. Are fixed costs above 60% of take-home pay? Is convenience spending replacing planning? Are subscriptions multiplying quietly? We are not judging behavior. We're identifying structural friction. Because money problems rarely come from one dramatic mistake. They come from design flaws. And design flaws can be corrected. Phase 2, days 31 to 60 stabilization. This is where most people make a critical mistake. They try to cut everything. That creates rebellion. Instead, we apply targeted compression. Reduce only 3 categories. 1 large fixed expense, insurance, refinancing, renegotiation. 1 recurring leak, subscriptions, delivery habits. 1 behavioral category, restaurants, impulse shopping, ride shares. Nothing else. The goal is a clean $400, $800 monthly improvement. Why that number? Because $600 per month invested at 8% becomes roughly $900,000 over 30 years. Most people search for complex investment strategies, but structural cash flow improvements create far more impact. The automation switch, critical. Once you've created breathing room, you immediately lock it in. Open high-yield savings account, low-cost brokerage account, then automate 10% minimum to investments, 5 to 10% to liquidity reserves before spending happens. This is called cash flow front-loading. Wealthy households don't save what's left. They spend what's left. That sequence change alone separates outcomes. Debt strategy, if applicable. If you're carrying 20% credit card debt, investing comes second. Because eliminating 20%, interest is mathematically superior to earning 8%. Increase payments aggressively. Call and negotiate interest rates. Explore balance transfer options strategically. Debt above 15% interest is not a minor inconvenience. It is negative compounding. And negative compounding is silent wealth erosion. Phase 3, days 61 to 90 acceleration. By now, you've stabilized your structure. Now we shift identity. Because wealth isn't just math. It's behavioral positioning. Income expansion strategy. There are only 3 scalable ways to meaningfully increase income. Increase your market value. Increase your leverage. Increase your ownership. That might mean negotiating compensation, switching companies, learning a higher value skill, building a side asset. Here's the counterintuitive insight. Cutting $500 monthly is helpful. Increasing income by $15,000 annually is transformative. Cost control prevents decline. Income growth creates escape velocity. You need both. Begin investing with simplicity. Do not overcomplicate. Start with broad market exposure. Low-cost index funds tracking the S&P 500 or total market. 1 fund is enough to begin. over long time horizons. Equities historically outperform most other traditional asset classes. But here's what rarely gets discussed. Compounding feels slow for years. Then suddenly, it doesn't. The first $100,000 is difficult. After that, growth accelerates due to scale. Most people quit before momentum arrives. Consistency is the advantage. Track net worth, not income. High earners focus on salary. Wealth builders focus on net worth. Calculate assets minus liabilities. Track monthly or quarterly. This single habit shifts your decision-making framework because you stop asking, "Can I afford this?" and start asking, "Does this increase or decrease my net worth trajectory?" That subtle shift changes everything. Define a 10-year vector. Now zoom out. In 10 years, do you want geographic freedom, early optional retirement, real estate ownership, business equity, seven-figure net worth? Reverse engineer it. If you need $300,000 for a down payment portfolio in 5 years, that's $5,000 per month invested. Clarity removes fantasy and replaces it with numbers. The real shift. Most people think financial stress is about insufficient income. Often, it's about insufficient clarity. Uncertainty creates anxiety. Structure creates calm. By day 90, your income may not double, but your relationship with money will change completely. You'll stop reacting. You'll start allocating. You'll stop hoping. You'll start directing. And here's the quiet truth. Financial control is less about becoming rich